Hello, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, December 13th, and you are tuned in to On Trend, the show designed to keep you on the right side of the trend. So we're going to start by measuring breadth over the last 5 days. I'll show you that I think support levels are very suspect in a downtrend. We'll look at bear market expectations, the breakdowns in several big equal weight sectors, and of course, we'll finish with some stocks to watch. Breadth indicators suggest that the reversal attempts have been very weak. So we're going to start with a chart of SPY, and I'm going to focus a little bit on the candlestick action. Now, when it comes to candlesticks, I prefer a tradable instrument like SPY as opposed to an index like the S&P 500. SPY has an open based on an actual buy order, and of course a close based on a buy or a sell. There's always a sell with a buy. And of course the intraday high and low are important because they show kind of the emotions happening during the day. But if we look at the candlestick action over the last 5 days or so, you can see first of all the decline, and then we had this kind of reversal day on Monday, and then Tuesday we opened strong but closed weak. And then Wednesday, again, we moved up higher, but closed weak. But, you know, if you take it all together, you've got a bit of a reversal trying to form here. And you could probably mark a resistance level right there at 272. So, you know, if you got follow through above 272, then you would have some sort of reversal working. Now, before I get into the reversal, I just want to note that, and I'll go into this a little bit later, but I think we are operating under bear market rules, if you will, because, you know, we had the breakdown here and we have kind of a consolidation after a breakdown that I'll show on the weekly chart. And then if we look at the last few days, you can see I'm using the volume just to show up and down days. I really don't use volume for ETFs or indexes. And you can see there's been 3 down days, the red volume bars, and 3 up days, the green volume bars. And what I want to do is I want to assess the breadth on these 3 up bars, especially to see how strong buying interest really was, if there was much. So in order to measure the breadth behind the price movements over the last 6 days, I'm going to show the advanced decline percent indicators, and I've showed these before. So basically it's the number of advances less the number of declines divided by the total number of issues. And I've got it for the S&P 1500 at the top, the S&P 500, and the S&P Mid Cap 400. And further below, I've got the S&P Small Cap 600 as well. Now, what we can see here is, first of all, here is where the S&P 500 is trying to hammer out that base or reversal with a first resistance level there marked by Friday's high. And then if you look at the breadth indicators over the last few days, we can see very strong breadth to the downside in 2 of the last 6 days. All right, we moved well below minus 75%. That's a bearish breadth thrust, if you will. Almost hit minus 75%. And then in between, we didn't get positive. And we got positive yesterday, as you can see, but we didn't get above 50%. So that wasn't a very positive day for me. I mean, I would want to see a breadth thrust above plus 75% to show broad participation. And then if we look at the S&P 500, we can see a similar thing. We didn't get above that plus 50% threshold, and we didn't for mid caps either. And then we scroll down to small caps. Now, small caps did, which is kind of interesting. So they got above 50%. So we showed a little bit of breadth leadership from small caps and from the NASDAQ 100. In fact, I'm seeing fewer new lows in the NASDAQ 100 and a little bit of less weakness. But still, as I'll get into it, I think we're in a bear market environment, and that means we need to kind of have bear market expectations. Now, the next indicator group I've got is the percentage of stocks above the 50-day moving average, and you can see those 6 symbols over on the left-hand side. It's got exclamation point GT 50 and then the index symbol SPX. So you can see on the next one we've got exclamation point GT50 MID and then below SML for small caps. So when we look at these indicators, what I'm noticing is, here from late October to mid-November, you had a higher low, and you can see that the breadth indicators improved. They hit their lowest point in late October, a little bit higher mid-October, a little bit higher in late October, and a lot higher in mid-November. So breadth was improving here. But now, when we look at breadth, we can see that it deteriorated during the December decline. In other words, we had more stocks hitting or moving below their 50-day EMAs than in late November. And so that suggests more participation to the downside, and that is negative. So when we look at mid caps, we can see a similar thing happening here. From late October to mid-November, we had fewer stocks going below the 50-day moving average. But then you can see here from late November to this December point, we had more stocks going below the 50-day moving average. So that is a negative. It shows more underlying weakness in the market. And then when we look at small caps and the NASDAQ 100, we can see a similar picture emerging. All right, less weakness from October to mid-November, and then more weakness from late November to early December because we had lower lows in the percentage of stocks above the 50-day. So that tells me there's still a lot of underlying weakness within these indexes. If the trend is down, then we should expect support levels to be broken. All right, now I know I just showed you some potentially bullish candlesticks forming in the S&P 500 over the last 5 days or so, but there is one big caveat hanging over that potential, or for the potential for a bounce, and that's the bigger downtrend. Now, I'll be the first to admit that, we could get a couple of positive headlines coming out. We could get a dovish Fed next week. We also have end-of-year seasonality, and that could lead to a bounce. And it could be sharp, and it could, propel the S&P 500 even above 2,800. All right, but I'm not sure if that would change the bear market environment. All right, I think the bear market environment is not subject to the noise. All right, I need to weigh the breadth indicators on any kind of a bounce to judge it. So you got to be careful going into the next week or so, especially. But when I look at the bigger trends, I think the bigger trend is down. And if I assume that the bigger trend is down, that means I expect support levels to be broken. And so support levels are very suspect. And so that's why I think it's very important that you make your broad market stance, all right, bullish or bearish, and then you analyze according to that broad market stance. So if you're bearish on the market, don't be marking support levels, all right? And frankly, since I'm bearish on the market, I probably should be ignoring those potential candlestick reversals. But let's face it, the stock market does have a long-term bullish bias, all right? There is a bullish bias out there. People want stocks to go up. The Fed doesn't want the stocks to go down. The administration doesn't want stocks to go down. Most people are long stocks. So there's a vested interest in stocks going up. So that's why we shouldn't get too bearish, I don't think. But that doesn't mean we have to be bullish. All right. So when I look at this chart for the S&P 500, I clearly see more bearish evidence than bullish evidence. All right. So first, if you look here, we had this massive advance in 2017, and then we had a triangle consolidation. So a consolidation after a big advance or after a new high is a bullish continuation pattern. And we got the breakout there and the move to new highs. All right. But now we've got something different happening. All right. Instead, we've got a breakdown and we've got a continuation pattern. So you can see here is the breakdown. We're below the 40-week moving average, which is equivalent to the 200-day moving average. And we've got a consolidation after the breakdown. So a consolidation after a breakdown and a sharp move lower is a bearish continuation pattern. And that's what I'm drawing here. So you can see that, if we do break down here, that's going to argue for lower prices. And you can say, all right, where's the next support level? Well, yeah, watch out for those support levels, because where do you mark support? I mean, you mark it at this low, you mark it at this low, you mark it here, you mark it way down here. I mean, you know, there's always some low that you can point out that's going to be potential support. And as far as I'm concerned, you have to take a broad market stance. Is the long-term trend up or down? If you think it's down, forget about support. What you need to worry about is resistance, all right? Because it's the resistance level that needs to be broken, and it's not expected to be broken during a downtrend. So that's why if you get a breakout above 2,800 with good breadth, then we have something to talk about, all right? Because if we break support, well, that's nothing to talk about because that's expected in a downtrend. But if instead we break resistance, then we have to maybe reassess the bearish environment that I think we are in. And just one more thing to point out down below, there you can see that the PPO 5260 on the left, you can see the settings, is below zero. So that means the 5-week EMA is below the 26-week EMA. That's just a little bit more sensitive of a moving average crossover. But all things point bearish on this chart right now. All right, so this is a chart of the S&P 500 equal weight index, and it shows us basically what is happening to the average stock in the S&P 500. And you can say, well, we're at support. We're at a support zone. And well, yeah, clearly there are these two lows here, and they come in that, 38.20 to 39.20 area, and, maybe mark support. But I think this is a very suspect support level. All right. The reason being is I think that this breakdown here was a bearish development for the market there for the S&P 500. This triangle is a consolidation after the breakdown, and we've broken below the triangle line. So that tells me that we are headed lower. And yeah, there you go. You can probably find another support level, but the question is, does it matter? All right. What really matters is the resistance level that you see there on the chart. All right. In order to get this downtrend reverse, we need to get it back above that 40-week moving average and back above these highs, which means above 4,200 to start reassessing this bearish assessment. Your expectations should align with your broad market stance. Now, if we go back to the SPY chart, when I was talking about the candlesticks earlier, that means we need to have bearish expectations, or we need to have realistic expectations if we think the broad market trend is down. So that means even if we do get a breakout here at 272, then realistic expectations, if the bigger trend is down, would expect that breakout not to be that successful. In other words, it might fail at 275, and then we might have another move lower. Also, when it comes to setting your expectations, personally, I rarely, if ever, use divergences in momentum oscillators. All right, I find that they work at best 50% of the time, at worst even less. I mean, you can see, you can always, for every bearish divergence you can find that works, you can always find one that doesn't work. So, here's a bearish divergence in late July, early August, and that didn't lead to much. Of course, we had this one here in September, and that led to a big reversal. But, all throughout 2017, bearish divergences didn't work. All right, so now we've moved into a bearish market environment, and you get bullish divergences. All right, but when do you play them? You play them on this gap? Well, you better take a pretty tight profit. All right, we got another divergence working here from October to November. All right, do you play it on this surge? Well, you better have a pretty tight profit exit. And we've got even bigger divergence working here. But the main point is when the broader market trend is down, these bullish divergences should best be ignored as far as I'm concerned. Finance, industrials, and consumer discretionary are leading the big sectors lower. So as part of the broad market assessment, I like to look at the equal weight sectors because they tell us what's happening with the average stock in the sector. And that's a much better barometer for the sector as a whole than, say, the sector SPDRs, which are weighted by market cap. Those will tell you what's happening with the large caps within that sector. But when you're trying to assess the broad market environment, I think you're better off looking at the equal weights. So I've got the 9 equal weight sectors coming up, and the picture does not look good. It looks bearish at worst. It looks not bullish at best. Clearly, these sector charts, the big sectors, especially consumer discretionary, industrials, and finance, are not on trend. And you can't have a bull market when those big 3 important sectors are not on trend. So if we look at these charts, I think consumer discretionary is the most economically sensitive sector, and it's one we should really be focusing on. And you can see here, there's a clear break below the summer lows. There's a break below the 200-day or the 200-day moving averages or daily charts. And then after this breakdown move, we've basically got this consolidation. And a consolidation after a breakdown is a continuation pattern. And so that favors a continuation lower, which we may be doing right now. So it looks like you have the first move, consolidation, and the second move underway. And then when you look at the indicator window, you can see that the 50-day EMA is below the 200-day EMA because the PPO over on the left side there, 50-200-0, is negative. And this is the difference between the 50-day EMA and the 200-day EMA. And so, I like to put on the 200-day moving average on the charts. You can see the red line there. So clearly, this is one of the most important sectors, and it's clearly not bullish. Then if we scroll down, we can see industrials, and it looks pretty much the same. All right, clearly not on any kind of an uptrend here. Sure, you had the 52-week high here in early September. And if you look back at your, patterns that were underway, you had a nice, wedge breakout there in the summer, but totally gave it back because you had this huge breakdown below the 200-day and below these spring-summer lows. And that is a 52-week low there. So when you have a 52-week low on the chart, you have a bigger downtrend. So if we look at the current pattern in play, we can see this bounce back to the break zone, and you can see a bit of a rising wedge taking shape, and we've broken that wedge. And so that wedge break tells you that we're continuing this decline that we had. So you have a decline, you have a counter trend bounce back to the break zone area, and a continuation lower. So I say that there's no way this chart is bullish. And then below, you got the 50-day EMA below the 200-day EMA. So, maybe we get another bounce or maybe choppy trading, but we clearly don't have an uptrend here. We look at technology. It's not as bad or as weak as the industrial sector that I just showed you. But what we have here is, you can see there's the kind of breakdown area. All right. And then you had a rally back to this breakdown area, and you're finding resistance below that 160 level and near that 200-day moving average. And basically, this is just a consolidation after the breakdown. So it's kind of like a rest. So what's happened here is you've had a shot across the bow, and you've broken down, and then you've consolidated to basically gather your senses or whatever. It's like the boxer being knocked down is staggering at this stage. But this is a consolidation after a breakdown, and that favors another breakdown and a continuation lower. And then the bottom window, 50-day EMA below 200-day EMA. So there's 3 big sectors. And here's the fourth. All right, this is the equal weight finance ETF. All right, the picture here, not positive, obviously, either. And it's been weak all year. There's the peak in January with lower highs. All right, and then we started breaking support levels here. And then we see that break zone turned to resistance. And so we got a bounce, and then another bounce that failed miserably, and a move to a 52-week low. So clearly a big downtrend in finance. So basically we have 4 sectors below the 200-day and 4, as you can see, with the 50-day below the 200-day. And these sectors account for like 70% of the market. So if they're in downtrends, how can the broader market be in a positive environment? And then we look at healthcare, okay? It's the fifth biggest sector, if you will, and it's holding up a little better, but you can see it's not immune. All right, there's the high back in January. We're below that high. All right, so things started going pear-shaped in October, and this equal weight healthcare sector is down. So that means the average healthcare stock is down. So there aren't a lot of places to hide. It's very hard to pick winners right now. And then if you look at the pattern taking shape here, it's kind of like you have a big volatile rising flag. So you had the first move down, and then we had a little bit of a consolidation, and it looks like we could get another move down to continue lower. So moving at these other ones just quicker, you know, energy's hitting a new low, so nothing but downtrend here. We look at materials, all right, that's an ugly chart, downtrend. We look at the equal weight consumer staples sector, all right, it doesn't look that great. I mean, it's still below that January high. Whoops, didn't mean to put that arrow on there. Let me just make that a straight line. Still below that January high. Haven't gone anywhere since August. So, you know, yeah, you're not losing money maybe, but you're clearly not making money. So is it worth the risk even being in staples? And then utilities, the only bright spot in the market right now and the only equal weight sector that is trending up really. Now we'll look at some bullish and bearish setups in individual stocks. All right, now I'm just going to review some ETF charts and some individual stock charts that have some potential setups working. But, you know, you got to be very careful playing the short side or looking for further declines because, you know, all it takes is a headline. All it takes is a Fed wording in the Fed meeting next week to produce a very sharp counter trend rally in the stock market. So, you know, sometimes it's best to sit on the sidelines and wait. And if you look at the broker-dealer iShares, I mean, how bad looking is this chart here? You know, it's just been moving lower since March with successive lower lows and lower highs. And if you have to put a pattern on it, you know, you kind of had this triangle consolidation, and we've broken out of that to continue lower. You look at biotech iShares. Well, biotech iShares are holding up, all right, but what I have to ask myself is, what's the bigger trend here? What are the odds favoring? And you can see here, you know, a breakdown here, support break, and then you can see that 200-day. It's not really a support level because you can see it moves above and below it a lot. But clearly, you know, you have a breakdown. And then this is basically a consolidation after that breakdown there. So a consolidation after a breakdown is a continuation pattern, and it's a bearish continuation pattern. So what happens within the range is anybody's guess. But, you know, given the bigger downtrend and the fact that this is a consolidation after a breakdown, you know, my guess would be a breakdown and a move lower even in biotechs. We look at transports. Here's another one that is not performing well. All right, you say, what is the bigger trend here? Well, clearly you had a big breakdown there below the 200-day, and then you had new lows coming in October. And then if we look shorter term, you can see this was kind of a wedge type advance, and then we clearly broke down again. All right, so transports have broken down again. That's not a good sign for the broader market. We look at regional banks, one of the weakest sectors around. We can see a couple of support levels broken there. I'll change to my line. There is a breakdown. And you can say, oh, well, there's support here. Well, it's broken. Oh, well, there's support here. Well, it's broken. I mean, once you pick your key level and it's broken, don't go looking for another support level. All right, it's over. It's broken. The next support level is not expected to hold. And then we have kind of this rising wedge and the breakdown to new lows. Then we look at aerospace and defense. You know, they're saying, Well, if there's one thing Congress can agree on, it's defense spending. Well, it's not reflected in this chart, and we have to base our decisions on what's happening with prices and on the chart. But clearly, there's a big breakdown there because you're moving below these summer lows, and that break zone turns into resistance, and it looks like, maybe there's a sloppy triangle working there, and we've broken down again. So no love for the defense group. And then we look at semiconductors. All right, I don't see any bullish evidence here either. All right, we can see this is rising wedge. And sure, we got a bounce, but I think it's a bearish continuation pattern because basically you have the breakdown of this zone here and the break below the 200-day. And then this is a throwback to the break zone, and now we're moving lower. So I would expect this one to continue lower. All right, now looking at these stocks, I'm trying to keep a few principles in play here. First of all, the bigger trend should be down. All right, we don't want to look for potential bearish setups in a uptrend. All right, second of all, there should be some sort of recent break of a continuation pattern, a bearish continuation pattern. So if you look at Arconic here, the big trend is clearly down. All right, the 50 days below, well, it's just above the 200-day, but price is below the downward sloping 200-day moving average. We had a little bit of a bounce here from July to September, October, but then broke down. And then here's the kind of continuation pattern. All right, you have the breakdown, a consolidation, and it looks like we're breaking down further here with the move below that continuation pattern there for Arconic. Then we look at Chevron here. We can see that there is a downtrend overall. There's a downtrend definitely. Get that arrow out of the way. And then, it's kind of volatile, but I would suggest that this is some sort of ugly wedge consolidation, and we're on the verge of breaking down here to continue lower. And then we look at Chiron. This one is a little bit more obvious. You can see that we've got a breakdown here, move below the 200-day with a very sharp decline. And then we have kind of a wedgie-like consolidation and a break below that. So that points to lower prices for C.H. Robinson. Sorry, I didn't say Chiron. But it, of course, is part of the transportation group. Cognizant Technology Solutions here, definitely a downtrend, no doubt about it. And then kind of a wedge consolidation and breaking down here. Then we look at IBM. This is maybe the new GE, if you will. It was holding on here, but clearly broke down to new lows. And then we have this kind of wedge pattern taking shape. And if it breaks down here, that opens the door to more new lows for IBM. And we look at Intel, all right, part of the semiconductor group, of course. I think the bigger trend is down. We had tried to break out there what I thought was a flag, but the breakout basically failed. All right, so then we have to go back to the drawing board, and it looks like we broke support here. Maybe there's a bit of a wedge working here, but I would be more bearish than bullish on Intel. Acuity Brands, there you can see a triangle consolidation and a breakdown. And Estee Lauder is kind of interesting here because they have this big island reversal. You can see the gap up and the gap down, and it looks like it is ready to continue lower. And that concludes this edition of On Trend. Thanks very much for tuning in, and have a great day.